when USO was trading the highest it had been the entire time you've been holding that position. So Yahtzee, my brother.
Yahtzee, my brother. Hey everybody, I am JC Parets, founder of AllStarCharts.com, and I am joined once again by my esteemed colleague, Mr. Sean McLaughlin. What's up, Shawnee?
Hey man, my arm's a little rubbery right now, so I'm not going to be too wild with my hands. I just shoveled a foot of snow, so bear with me.
Look at that. It's a good workout, that snow shoveling. I don't mind it.
Ooh, yeah, it's not as fun when it's 11 degrees outside, though.
I like choosing whether I want to do it or not, you know? Like, I want to have the option. So I feel good about it if I'm doing it and I don't have to. I feel bad about it if I have to, you know?
Well, see, that's the difference between you and me. I'm a good neighbor, and I like to shovel my sidewalk for everybody else, you know? We all benefit.
I don't have a sidewalk. It just goes straight to the street.
Oh, okay. Well, you're lucky.
All right, so we got a trade. I really like this one a lot. I like that we can let it dance. Chevron pushing up against new all-time highs. Sean, best performing sector of 2021 was energy. Best performing asset class of 2021 was commodities. So far this year, same exact thing. Energy dominating the equities market. Commodities best performing asset class. But, you know, Chevron's come a long way. So if we're going to make a call on Chevron to have some time to let it work out, eventually break out of this base, it doesn't have to happen tomorrow. We have 2 years. Let's think through this. Let's talk about it. What are we seeing here?
Yeah, so we were talking about this trade this morning in our company analyst meeting, and we were all in agreement that this breakout was significant. But when we were looking at a more near-term chart, looking at the price action of the last 4 or 5 months, we were all kind of like, ugh, it's kind of dicey buying here. This thing could pull back a little bit. We might be chasing it. And so my initial impulse was, let's wait and see. Let's let this thing, maybe go a little sideways for a little bit. And then the conversation moved on. You guys went on to another topic, and I just decided on a lark, I'm like, well, let me go look at the long-term options in this thing. I don't usually look at the leaps. I don't usually go anything further than 6 or 8 months out, but I don't know. Something told me I should maybe look at the leaps, and I pulled up the options chain, JC. And I mean, you guys heard me in the meeting. I looked it up.
I was there. I saw it.
I was like, guys, holy cow! Look at January 24. We're 2 years out. You could look at the 150 strike, which is only $15 away. You could buy those calls for around 10 or 11 bucks. And I was just like, wow, that's crazy. And of course, Straza immediately he goes, we could get there next month. And so
what I like about this is we can, right? Chevron can hit that strike next month, but that's not the bet we're making. Like, if that happens, great. If that doesn't happen, that's fine too, right? That's not the bet we're making.
That's not the bet we're making. But I mean, man, the fact that it only costs us $10 or $11 to control a position in Chevron for the next 2 years above 150 bucks. I mean, geez, do you think Chevron can move 11% over the next 2 years? I mean, look at the move it's had just in the last, year.
130, 150%, yep.
Right. So for us, it was almost like a no-brainer. Like, we'd be irresponsible not to take this trade. I mean, the volatility has come down. The options are pretty cheap. And options generally, I don't want to say across the board, but options generally tend to be cheaper when you go really far out in time in these leaps. I don't know why. I've never understood why that is, but they tend to be cheaper. So, man, to pay 11 bucks to control this stock for playing for an 11% move over 2 years just seems like a no-brainer. So that's the thinking behind it, JC. That's why we got in, and it gives us a lot of time for this thing to play out.
I can't emphasize this enough. It's come a long way. So to place a bet where you're not only calling for the direction of the price, but you're also having to do it within a certain time frame, I think that's tough. I really like the idea of having exposure to energy. Think about it. A lot of American investors don't have that energy exposure. In many cases, they've missed a big move and are like, oh, I don't know if I'm ready. By the time they start making those moves, you'll probably see Chevron much higher. So I want to talk about the trade management here, because from a risk management standpoint, you're shelling out the money for the call option and you're holding it for 2 years. you're basically signing that away. It's like a VC investment. Technically it's liquid and you can get out, but just the thought process behind it, you're writing it off, you're cutting the check and it's gone. Now let's just say that it starts working, right? So that's the risk. The risk is what you put up. Great. But what about when it starts working? We have some Fibonacci extension levels here that could potentially take into the 180s as high as 270, which would be twice the value that it currently is. I know that you don't want to let the cat out of the bag and like get too far ahead of ourselves, but let's open that up. And, you're thinking about selling some call options along the way, assuming that we're in the black.
Well, so we discussed a couple of things, and let's start with what we always do when we buy long calls, JC, and that is we always look to sell half of our position when we get a double.
Even in a leap.
Even a leap. I mean, because, and it might even be more important in this leap, because when we get a chance to sell for a double, then, man, having a free call option for the next year and a half or 18 months in a stock that's uptrending, I mean, how sweet is that, JC? That is like the best of all worlds. You've got no risk in the trade and potential for unlimited profit. And you've got these Fibonacci extensions listed up here. We were kind of joking before we went live about how man, if Chevron goes up 100% in the common, which is not out of the question over the course of 2 years, the return on the options will be astronomical. I can't even do that math, but it'll be fantastic. But so that's the first position management. That's our default way to manage long calls, whether it's a 6-month position or a 2-year position. The other thing we discussed, this is more, I don't want to call it expert level. It's not expert level, but if people are interested in this and if they have some comfort level with selling covered calls, with a position that has 2 years expiration, you could theoretically treat this position as if it was a long stock position, and you could sell covered calls against your stock position every month, right? Like if you did it today, I would maybe look 2 months out, sell an out of the money call that's at maybe a 25 delta, bring in whatever that premium is to lower your cost basis. And then when you get inside of, a month or 3 weeks expiration, you just roll that call out to the next month at the next 25 delta, bring in more credit, and just repeat that over and over and over again for the next 2 years. And you'll start chipping away very meaningfully at that cost basis, which just overall enhances your return or minimizes your loss in the case we suffer a loss. Now, I didn't lay that plan out in our piece because there's a lot of different ways people can do that, and there's no one right way to do it. But something to think about. This is a position, because we'll have so much time in it, you might want to consider, if you're playing along, might want to consider selling some calls against it as a covered call-like position.
I really like the idea of being in a position where you're playing with house money. So if the call option, the premium doubles, you take half off the table. That happened in crude oil. We put on a trade long crude oil a year ago. We were able to buy, this is twice as long until expiration, but this is definitely the longest trade we've ever put on. The oil trade was the longest trade up until that point. We took half off the table, and oil just kept running, and that ended up being a great trade because we're playing with house money. You're not wondering, oh my God, am I going to lose? And you have nothing to lose, so you could really let it run. In this case, we have 2 years. We're able to take half off on a double and just let the rest run. I mean, who knows how high these things can go, because Chevron's done nothing for 7 years, Sean. 7 years. And I don't know if you heard, but stocks have been in a bull market. This one didn't get the memo. Playing a little catch up.
Well, and go back to that USO trade real quick. With the benefit of hindsight, it was a really good thing that we were able to sell half of our position early. I mean, it was early on, right? We got into that position in February of 2021. And within, I think it was like 3 weeks or 4 weeks, we were able to sell half for a double. And then that allowed us the comfort to ride it for the rest of the year. And there were 2 meaningful pullbacks during the year, 2 bases that built that, we might have been a little bit more uncomfortable with had we been holding a full position at that point, because our P&L swings would have been a lot more dramatic. But because we knew that, hey, man, worst case scenario here is we walk away with a scratch, that gave us the comfort to all right, let's just let it do its thing. Let's not worry about it. Let it build its bases. And it built 2 consecutive bases over the course of 6 months. And hey, lo and behold, this rarely happens, JC, but on expiration day in February or in January, just a couple weeks ago, we got out when USO was trading the highest it had been the entire time we've been holding that position. So Yahtzee, my brother.
Yahtzee, my brother. And I just want to reiterate one last thing before we run. And that's the fact that this doesn't have to work tomorrow.
Nope.
Because if I ask myself two questions, JC, do you feel comfortable getting aggressively long a position and energy right now after the move that it's made, thinking it's going to work right away? No, I'm not that confident about it. Can it? Yes, but I'm not that confident about it. Or, JC, do you want to have added exposure to energy over the next 2 years? I think that's, for me, that's a 100% yes. I want more energy exposure over the next 2 years. Do I want it over the next 2 days or 2 weeks? Maybe, but probably not. But the next 2 years, for me, 100%. And I think this is one great way to do that.
Well, let's just add one final piece of this, JC. We do have a risk management level that we're going to keep an eye on, and that is the 110 level. If Chevron trades back, if it turns out that this was a fake out breakout and we pull on back, 110 is a level that Straz and I were talking back channel, that we kind of identified that if it's below 110, then that probably signals to us that not only Chevron, but the entire oil space is not doing what we think it should be doing. And therefore, we're going to take the trade off, take our small loss, and, wait for the thing to set up for a better opportunity.
I'm writing it off as soon as we cut the check. I appreciate what you're trying to salvage, and that adds up at the end of the year, no doubt. In my head, it's a write-off as soon as you cut the check. See ya, it's gone. I'm okay with that. I'm okay with that.
All right. Hey, you do you, JC.
I know, I will. See, I like this. All right, Shawnee. Ladies and gentlemen, Mr. Sean McLaughlin, hit us up, info@allstarcharts.com if you have any questions. Follow Sean at Chicago Sean. Follow us at All Star Charts. And we'll see you next week.
See you, everybody.
Adios.